earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
Good afternoon, everyone, and welcome to the School of Cash Flow podcast. I'm your host, Dale Corpus. So passive real estate investing is something, as you guys know, I'm really passionate about. It gives you more options of what you can do with your life. You have more control of your time. You get more freedom and flexibility. So you could spend time with your friends and family, which is what really matters in life. And I've always aspired to have enough income from, investments to cover my daily living and housing expenses. So I really could just focus on doing, what I want and whenever I want. I mean, I like to do a lot of positive things and, really be out there in the community and, do good. But side note is, you guys could always passively invest while maintaining, your day job or your business. And I mean, that's how I've been doing it. And I actually love what I do as a realtor. And I love everything that real estate's, given to me, but it's like, I love investing too. And it happens to be in real estate. And for me, I know that one of the motivations is why I actually work so hard on my day-to-day, business is actually to build more of the income, which I end up investing. So it's kind of like a cycle. My main business feeds into my investing business, and I eventually turn my active income into, passive income. And anyway, I'm really excited to bring on my guest today. His name is Ben Kogut, and it's really interesting. We haven't really spoken ever on the phone or anything like that yet. It was only emails and DMs. So this is a first for me. It's a virtual world we live in, definitely. Got connected through Ben via LinkedIn because we have a common friend named Adam Carswell that has a private Facebook group regarding podcasts that we're both in. And anyway, Ben specializes in raising capital for commercial real estate syndications. And again, they're passive income vehicles that we're going to talk more about in this episode. And I've been investing in real estate syndications myself for the last several years. And, you know what? I wish I knew about them sooner, but it's greater. It's good to start, at least now than never start at all. But they're a great vehicle to build cash flow and wealth. And a little bit more info about Ben. He is a partner and head investor of relations for HJH Investments. So HJ protects and they grow their investor capital through commercial real estate syndications, and their investments includes industrial buildings, shopping centers, and office buildings, which are typically anchored by high credit tenants with long-term leases throughout the United States. And HGH has over 350 million in assets under management. And so Ben's based in Austin, Texas, and he has an MBA and CCIM certification. So sorry for the long-winded intro, but Ben, how are you?
I'm great. Thanks so much for having me today.
Is there is there anything else you wanted to, say to introduce yourself, to give my listeners even more background and what your focus is even right now?
Yeah, so similar to you, I started as a realtor and as a broker, and I started taking the commissions that I earned and investing them in other people's real estate projects or syndications. And then, I started learning this world, and then I basically made a complete pivot from being a transactional broker into somebody that is now raising capital and basically being a partner and a sponsor of acquiring cash flowing properties. Mm-hmm. And so that has allowed me to generate passive income for myself and my family. But not only that, what I really love is being able to help other people do the same for themselves.
Yeah.
And so, so that's kind of what brought me down this path.
No, that's excellent. I mean, it's great that you came from the brokerage world prior and now you switched over. I'm curious, even before you became a broker, how did you get into real estate? Is that something that you studied in school?
Yeah, so I went to the University of Texas here in Austin, graduated in '04, and I wasn't sure what I wanted to do with my life. So I interviewed 50 entrepreneurs here in Austin, and I found that there were what I gravitated towards were the people that were involved in commercial real estate. And so I latched onto them as my mentors, and I still have most of them as my mentors still today. And really just I got into commercial real estate in 2004, 2005, and I haven't looked back. So I've been doing this for about 16 years now.
So, right now you switched over from being like a broker to doing stuff that's more transactional to raising capital. Like those are completely different skill sets. I mean, like how did you have, what did it take for you to learn how to raise capital, since it's completely different from, brokering real estate?
Yeah, it is a mindset shift. And I think it primarily starts with a newfound passion for teaching and for educating. And so I really, instead of like, I'm not really a sales guy. I think of myself more like as somebody that teaches about commercial real estate and triple net properties and passive income and the tax benefits that come from that. And so that's one thing. But I think as a realtor and as a broker, I think that you do, as you know, spend a lot of time teaching people about investing just in that single purpose real estate project or house or whatever it is. So that's one thing. And then number two, I mean, this is also, relationships. It's always about relationships in every way. So a lot of the people that I was representing or doing deals with as a broker are now people that are investors with me in a variety of different projects. And so, those are like two really like easy ways to transition into this. Yeah. And then just, raising capital is just, about, if you find the right deal, the money will find you. So we really focus really hard on making sure that we buy really high quality commercial real estate.
And that sounds amazing. I mean, what I love about real estate is, like you said, it's like about the relationships. So like people that I went to grade school with, even high school, college, and other places that I worked out even before being a realtor, it's just like I stay in touch with them and they end up becoming my clients. They followed me, and it's just all those relationships that you pick up along the way. They really help you, explode the growth of just your business and whatnot. I always feel like one of my previous real estate coaches and for sales coaches always says that I was like one relationship away from having my business explode. It's like, I always took that to heart. And it's always like, I was always like, I just need to keep meeting people. I mean, it's just great that you were saying, it's all about the relationships, because it really is. What kind of skills?
Agree with all that.
No, absolutely. No, it's amazing. So like, that really resonated with me, by the way. So what skill sets do you think it takes to raise capital?
Yeah, so I lean a lot on my education with my MBA as well as my CCIM designation, which is basically a commercial real estate designation. And so, having the background in those, to be able to have financial analysis skills, to basically be able to underwrite the unit economics of the tenants that occupy the real estate that we're looking to buy. So for example, we buy shopping centers, office buildings, and industrial properties. And what I like to look at, and what we look at as a team, is we look at, okay, so who is it that is the tenant in the real estate? And usually it's someone a tenant that has high credit and more than 5 years of lease term remaining. So when we're buying this shopping center or office building or whatever it is, we know sometimes to the penny how much revenue is going to be coming into the landlord on day one. And so what we like to look at is, okay, the unit economics. How many widgets or services does that tenant need to sell in order to break even? Right. And so we'll dig into that. And in other words, can they afford to pay the rent that they signed a lease obligation for? Because what we're looking to buy is commercial real estate that has predictable and consistent cash flow. And if we can buy it better than a 9 cap, then we can afford to pay our investors a monthly dividend on day one. And so that's generally the background and how we look at, and then there's other factors. Is it a good location? Is it an area that's growing? Is it shrinking? Is it a tenant that's going to get, destroyed by Amazon over time or not? Because there's a lot of tenants that are not, that are, restaurants or bars or services or doctors, or we do a lot of medical office, things like that, they're not going anywhere. Right. And so, in fact, they're just getting better.
Yeah.
And so we believe in commercial real estate as a hedge against inflation. There's many tax benefits to owning commercial real estate. And we create these opportunities by basically creating syndications, or you could call them like fractional ownership, for people that may not be able to buy a $20 million grocery anchored shopping center, but instead we're giving you an opportunity to own a piece of, the bigger pie and the benefits that come with that. And so that's generally how it works.
Okay. So obviously you work over at HGH. I mean, and then you guys specialize in the industrial, the shopping centers, and the office buildings. Do you guys have, I know that's three separate types of asset classes and whatnot. Do you focus on them equally, or is there one that, like right now, that you focus on more?
Yeah, so we're pretty diversely spread across that. What they all have in common, again, is that they're going to have a great quality tenant, someone that has been, usually they've been there a long time. And if they haven't, they're going to be there for a very long time through a long-term lease with a great quality of credit. And so in today's market, we're in September of 2021. We've been finding that there's a disconnect in the market between in the medical office space or in the office space, debatable on are people coming back to the office. We would argue, and we're seeing that the employers do want their employees to come back to the office. It's not the same across the board, but especially with medical office, they can't do what they need to do for a variety of reasons from home. So they are showing up to the office, and we happen to find that there's a lot of opportunities in the Midwest. And so I'm based in Austin, Texas. I have teammates that are based in Kansas and Michigan and Ohio. And so we have relationships in Indiana and that part of the world, the United States. And so we've been finding that there's a whole lot less competition of investors who are looking for deals like out there. And so therefore, we're able to pick up these deals at better than a 9 cap, when if they were here in Austin or probably somewhere in California or whatever, they'd probably be somewhere in the 6 cap range. And in case anyone doesn't know what cap rate means, it's a commercial real estate jargon, stands for capitalization rate. And it's basically the simple way to say it is it's basically what kind of percent return you're going to get. So if it's a 6 cap, you're going to get basically 6% return on your money. If the 9 cap, so on and so forth, it's a 9% return on your money. So that's the simple way of explaining what a cap rate is.
I know, I guess I'm not as familiar with, the commercial real estate space and whatnot, but like some of the tenants that you work with are like big companies, big corporations. I'm sure it's like, what does it mean to, like have like a high credit rating? Is there like credit reports or something like that, that are run for corporations? Is like, how does that work?
Yeah. So we recently bought a building that's occupied by Walgreens.
Yep.
Everybody knows Walgreens. Right. So and if you drive around your neighborhoods, someone owns that building and it's not Walgreens. They're just tenants that lease, from various landlords. So that's, Dollar Tree. So a lot of these companies are publicly traded, and you can actually look up what their credit rating is. Our typical credit rating is BBB credit or higher. And that's just a high credit rating. So in other words, they're going to pay their rent, because if they don't, their credit rating is going to be impacted. And none of these companies want that, because it has an impact on their, overall financials. And so oftentimes we'll buy deals that have a high credit tenant that occupies a large portion of the building. And then there'll be some other smaller, maybe just like a freestanding dentist or, some sort of doctor or something like that. That's cool and all. They're not likely to leave, but there is a possibility that they leave. And so we look at, okay, is their rent high? Is their rent low? Is it just at market rate? And if they do happen to leave, what's it going to cost us as a landlord to find someone else to come back and take over that space? So, we raise money on a deal by deal basis. Mm-hmm. So if someone was interested in, becoming a fractional owner and part of a syndication, they could reach out to me. They could, become educated. We can get them on our investor list. And once you're on an investor list, you can, you can opt in to any particular deal you want. And if it's something that doesn't appeal to you, yeah, no sweat, no problem. Wait till the next one. We do somewhere between 8 and 10 deals a year. And heavily in the fourth quarter, that's when we find that the sellers are most motivated to do a deal that's better than a 9 cap, mm-hmm. which is, hard to find, but definitely doable. We've bought 59 assets so far in the last 5-6 years, mm-hmm. and growing. And so it's about, having the right team, the right track record, transparency, relationships, and education. And all those things are part of what I get to do as the person that's in charge of investor relations. And honestly, I'm just having the most fun I've ever had in my career.
I love it. I love it. So what does a typical investment offering look like? Like, what's your typical investor looking at, a minimum amount to invest, like what to expect?
Yeah. So I'll get I can give an example of something we recently did. Yeah. It was a single tenant office building in Houston that is occupied by a company called Jacobs Engineering, which is a multi-billion-dollar engineering firm. Mm-hmm. It was about a $20 million building. They have a long-term lease in place, and they are basically the number one engineer for NASA. Mm-hmm. As in NASA, and it's next to the NASA campus in the Houston area. And so, for example, it's usually about $100,000 minimum for somebody to get into that deal. And they're going to, and I can't talk about returns. There are SEC rules around that, but what I can say is that that deal was paying a dividend right on the next month. So, and then they've gotten those investors have gotten dividends every single month for the 15th. It's all automated. And yeah, they'll also get a K1, which means that they have ownership in commercial real estate. There are tax benefits to that, just because of, I don't know if you guys have talked about cost segregation and accelerated depreciation, bonus depreciation.
Yeah. So you guys are doing all of that cost segregation stuff to just, to get... which a lot of times makes those K1s negative, which helps out tax-wise, especially if you're using money outside your SCI IRA. So makes sense. In terms of so you guys have a preferred return type of structure with an equity split. Curious, what kind of equity splits do you guys have?
Yeah, so we'll talk about that last deal. This is the area of, I can't actually talk about splits and returns and stuff like that. It's just part of the SEC rules. So let's
if there's a way to talk around it.
Yeah. I mean, just know that it's a very favorable arrangement, and we've been able to raise over $100 million with what we created. You'll find that I find at least that most of the people that are talking about syndications are in the multifamily business. People are buying apartments, right? And so we took a different approach with our background in commercial real estate and buying triple net properties. And we like triple net properties because as the valuations go up and the taxes go up, it's typically not the responsibility of the landlord to pay property taxes. It's an expense that we can pass through to the tenants who are responsible for any taxes or insurance or common area maintenance.
Yep. Like that. No, absolutely. One of the reasons why I was excited to bring you on is because of the fact that the syndications that you offer are different. For example, I have not, invested, in a syndication where there was a triple net lease and whatnot. I mean, speaking of which, can like a lot of my folks don't understand what a triple net lease is. Can you explain what that is?
Yeah, absolutely. So triple net is net, triple net, the net of the taxes, insurance, and maintenance. And so, every commercial real estate property has those three expenses. And when they're described as a triple net property, that means that instead of the landlord paying those expenses, like maybe like in an apartment complex, for example,
Yep.
The tenant pays those expenses, plus they pay rent to the landlord. And so as a landlord, we don't want taxes to go up on the properties, but inevitably they usually do. And it's not going to, we don't have to worry about it as investors because the tenant is going to, absorb those costs.
Okay. A lot of these leases that you're talking about are, again, long-term leases, like around 5 years or so. Residential is completely different from commercial, but say one of those tenants, for whatever reason, they weren't paying or just, couldn't make the payment. Like, does things like evictions and stuff like that happen over in that space? Or how does that work?
So yeah, it's not impossible for evictions to occur, but it's not very common, especially for as far as I know, we've never had to. Maybe there's some examples, but when we buy a tenant or a building that has a tenant with a high credit, if they decide to leave, they're still going to continue to pay the rent for whatever their lease obligation goes through. And typically, if they are deciding to leave the building, they would notify the landlord, and it would give us an opportunity to go back out into the market to go and hopefully find a new tenant to backfill and take over that space. That happens from time to time. I mean, in COVID at the beginning, we had to, we offered our tenants an opportunity to basically waive, rent. Some took us up on it. Most didn't, to be honest, which was surprising at the time. And so for some of those that did, we'd say, hey, we would negotiate on a one-on-one basis. Oftentimes it was 1 free month of rent in exchange for another year of lease term. And so that way it gives us as landlords more stability and predictable cash flow. But at the same time, it gives them the opportunity to not have to pay rent, or maybe they deferred the rent to pay it in the future. Like there's a lot of different ways to cut that up. And frankly, I think that we're significantly better off now, believe it or not, than we were at the beginning of COVID, which is kind of mind-boggling, but it's definitely a really good time to be an investor in commercial real estate.
I got it. So COVID question again, how did COVID, affect your investments, the asset classes that your company focuses on?
Yeah, so in a lot of instances, it didn't. In certain cases, it did. And kind of what I was just talking about, we, for especially the mom and pop tenants that are next to some of the bigger ones, we would give them the opportunity to renegotiate their lease, whether to kind of pause paying rent or pause, the triple nets or something like that, just to kind of help them out. Because as a landlord, it doesn't benefit anybody, or especially us as a landlord, to see them leave. Like that's never what we want to do. We want to sit on the same side of the table and work something out that works for everybody. We did have some wins, to be honest. We bought a building in Missouri that was occupied by a tenant called Academy Sports.
Yeah.
And so this is kind of a fun story. It's kind of like a Dick's Sporting Goods, a massive chain. And so we bought this building because their credit rating actually went down, but it was still within the realm of what we like to buy. But the seller was a publicly traded REIT that was mandated only to own commercial real estate with a certain credit rating. Okay. And so it dipped below that, but still within our realm. We bought this building at a massive discount. Like I think the seller, the REIT, lost probably a couple $1 million selling it to us. Okay. And we have a system for acquisitions to find off-market deals and below-market deals, because that's pretty much all we do buy. And fast forward, they wanted. So we had an idea why their credit rating was reduced. And it was because they hired somebody to come in-house to renegotiate their corporate debt. And he was able to successfully do that at below par. So he paid off less than what was owed. And that caused the credit agencies to reduce their rating.
Okay.
Fast forward, at COVID, we negotiated 2 months of free rent. And in exchange, they added 2 years. So they went from a 9.5-year lease to an 11.5-year lease. And then fast forward to about a year ago, late 2020, they went public. So they had a successful IPO. Mm-hmm. And as a publicly traded company, we knew now we had an 11.5-year lease. But now we have a tenant that's publicly traded. Even though we gave up 2 months of free rent, which is probably close to $100,000 in value, we decided that it was time to flip the building. So we ended up selling the building just about a year after ownership for a pretty meaningful profit to our investors. And that's just like it's a rare, but it's an example of something that ended up being better for us during COVID, because everybody was going and buying sporting goods and doing home activities and stuff like that. And we knew that was going to be the case. Plus, just there's significantly more capital in the market than deals. Just, you could call it inflation. You could call it just, good times in the market. I don't know what you want to call it, but we knew that we'd be able to find a buyer that'd be willing to pay significantly more for the asset than what we actually bought it for. So just a little taste of some things that we're seeing out in the market.
No, that's amazing. Going back to what you were saying, like for syndications, there's a lot of people even listening to this show already that invest in syndications, but it's mainly, a lot of it's multifamily. So like them hearing from you, which is a completely different asset type of class, it's like, can I ask you what's any advantages to consider, this type of asset class, whether it's industrial shopping centers and an office, like trying to see like what's the difference between looking at that versus looking at multifamily?
So it's such a great question, especially for me. Thank you for that. So I happen to have written a short ebook called The 5 Things to Consider when investing in a commercial real estate syndication. And so you can find that for free, hjhinvestments.com/book to download that. And in that, we talk about the different things to consider. And so within that, I go into depth with Professor Solomon from the Harvard School of Business, talks about the 4 rules of cash. Have you studied are you familiar with the 4 rules of cash?
I don't think I am. Yeah. Well, can you enlighten me?
Sure. So, we go into more depth in it, but at a high level, it's real simple, and it gets deeper, but at a high level, we'll talk simply. So, rule number 1, cash now is better than cash later, right? Mm-hmm. So what does that actually mean? So what I mean by that is I'm going to broadly compare commercial real estate to multifamily. It's just broad. Okay. So in multifamily syndications, often what happens are you make an investment, and then 24, 36 months later, whatever it is, the sponsor will sell the property or refinance it, cash out, and give everyone back their cash. So there's a lengthy time period where you're going to actually get some money back. So what Solomon says is cash now is better than cash later. And so what that implies is when you invest in a commercial real estate deal that's already has the cash flow, like the deals that we do, you're going to start seeing cash on the first month, and every month after that, as long as the cash flow is still there, versus multifamily. So that's just one way to look at it. Another rule is more cash is better than less cash, which again, duh. Right. And so I go into more depth about what that means. Less risky cash is better than risky cash. And so when you're comparing different asset classes, I'm not saying that multifamily, I'm not even trying to compare it to multifamily. I'm just saying when you're looking at, in general at risk,
Yep.
you want risk to be, it's called risk adjusted. Risk is okay as long as the potential return is in line with the amount of risk that you're looking to take on.
Mm-hmm.
And then rule number 4, and this is the rule you never want to forget, never run out of cash. And so so we go into more depth about what that means, but really what you want to make sure is that the deals are fully and properly funded, and that you're not going to be set up to be exposed to a potential cash call. And so there are ways to mitigate that particular risk, unless it's something that you're not concerned about. But usually when people put money into a deal, they don't, even if things don't go according to plan, they oftentimes don't want to be, exposed to a potential cash call. And so the way that we structure deals is we have an ultra high net worth individual personally guarantee the debt and be responsible should there be a need for more cash in the partnership, which we structure deals to have robust amounts of reserves. And that number varies from deal to deal. And it's all explicitly stated in the offering memorandum and PPM and all that stuff. Mm-hmm. And so just, things like that, you may be okay going into another deal, whether it be multifamily or otherwise, where you put some money in and that potentially you're going to have to put more money in sometime in the future. And that's okay as long as you know that that's, what's coming down the pipeline. But what I'm seeing is most people just want to be in, they want to get their monthly dividend, they want their tax benefits, they want, regular updates like quarterly, for example, and they don't want to be bothered with it. Mm-hmm. And so those are just some examples of what some of the benefits are of commercial real estate passive income investing look like.
I obviously know you invest passively as well. I mean, what do you like to invest in passively, and what asset classes is it? I mean, is it mainly the stuff over at for example, at HGH?
Yeah, I drink the Kool-Aid that I serve. So I'm heavily invested in I'm proudly invested in HJH investments. And I started as an investor.
I was going to ask you about that. What was the connection? I mean, how long has HJH been around, and how did you get connected to them and to be their capital raiser guy? Mm-hmm.
Yeah. So Corey Harkleroad started the company 5 going on 6 years ago. He has a great story about how he started it. He also transitioned from being a real estate agent into syndication. And we met at a real estate.
That's the progression. That's the progression, huh? Yeah. Anyway, keep going. Sorry to interrupt you.
Oh yeah. I mean, we both love what we do, and we're blessed in that way. And we met at a real estate networking event, and I had cash from, I had equity and deal. I had an opportunity to invest. I made an investment with him in one of his deals. I started getting passive income, and I was like, this is pretty cool. Let me learn more. And then we built a relationship. He became a mentor of mine. And then he saw the skills and the relationships that I have. And he basically made me an offer I couldn't refuse to become a partner in the company, and more or less, handle the investor relations side and the podcasting and teaching, and sort of, I wouldn't say I'm not the face of the company, but I'm more forward and out there sharing our story than, he likes to, kind of be behind the scenes, kind of running things and all that kind of stuff. So it's a really great partnership.
No, that sounds really cool. Kind of related to folks that are in the middle of investing right now, say a 1031 exchange. Are you able to help those kinds of folks? Mm-hmm.
Yes. For people that have a 1031 exchange, timing is everything, both from the perspective of the timing from when you sell, because you're going to have a finite amount of time to identify and then close a property, as well as on our side, if it is something that you wanted to exchange into, we will create what's called a TIC, which is a tenant in common partnership. And it's basically, and I'm not an attorney, and I'm not giving any financial advice, I'm not a CPA. Having said that, it's basically, you're going to go off the deed of whatever you sold, And there are certain IRS rules that you have to check those boxes in order for it to be kosher to go onto the deed of another property. And through a tenant in common partnership, it's basically like you're a partner with our syndication partnership. And so you will be on the deed, you'll have the same responsibilities. And so it's a little bit more complex and probably not enough time for this podcast, but there are ways to help people. But what I would have to say about that is if you are in a 1031 scenario, let's have a conversation sooner rather than later so that we can see if it's going to be a fit for your goals.
I'm actually glad I asked you that question because it was my understanding that I couldn't, like 1031 exchange money couldn't be put into a syndication. So, I mean, this sounds like a creative, workaround that fits the IRS rules. And I've actually never heard of that before yet. So thank you very much. Going back to HJH, how are you guys finding all these deals? Is it mainly off market? Is it on market?
So we have a lot of off-market deals come our way, but really we have an acquisitions team that's headed by John Post in our office, and he looks at between 800 and 1,500 deals every day, which is a massive amount of deals. And we have a very specific box, again, high credit, long-term lease. And if it fits in our box, we'll make on average about 16 offers a week on a variety of those assets around the country. Typically, I'll share a few ways, some of our, I wouldn't call them secrets, but techniques that have helped us be successful with winning deals. Number one, we'll typically send a purchase contract right away as opposed to a letter of intent. And so let's just cut to the chase and get down to business, number one. Number two, when we send that contract, we'll typically send it within 24 hours of reviewing the deal. So we'll do a very quick underwriting. And then number three, we're going to preemptively send a list of references.
Okay.
So other brokers, buyers, sellers, investors, like bankers, these are people that will vouch for us that we do what we say we're going to do, like to the T, extremely high integrity at all times. And then number four, we promise them that we'll personally be on site within 2 weeks of being under contract, no matter where it is in the country. And so that has me and my team traveling extensively, which is cool. It's fun. Even throughout COVID, we haven't stopped traveling whatsoever. And we win a lot of deals that way. And I'd say about 2 out of every 3 deals that we put under contract, are going to pass our DD process. And stepping one step back, 1 out of 16 offers that we make, we're going to be able to put under contract. So those are the general metrics that we're seeing right now.
Yeah, I mean, for all these leases and whatnot that you do, I know that having a strong property management team is very crucial. I mean, do you guys do your own property management, or how do you manage all of that?
Yeah, great question. So we took the approach with management where we split it in half. And what I mean by that is the physical side of things, the roof repairs, landscaping, this thing's broken or whatever, all those things, those are handled by a third-party company that's local to wherever the property is, so that if they need to get on something immediately, we have local resources to handle that. And then the other half of management is basically the financial side of things, collecting rents, paying taxes, insurance expenses, so on and so forth. So we have a 5-person accounting team in-house that is partnered with a CPA firm called BKD, which is a national firm. And so all of our books are handled so that they're all, we have control of it, and all of our reporting, which comes out 4 times a year, it makes it easier for us to have all that reporting so efficiently.
Mm-hmm. Kind of going back to the COVID question, as it relates specifically to retail and shopping centers. I mean, is it like with COVID, with shopping centers, not people flocking to them as much during COVID. Like, what kind of opportunity is there in that space when you have so many online retailers and people have shifted the way they do business, versus having to actually go to a shopping center in person?
Yeah. So, shopping centers, like think about wherever the nearest shopping center is to you and around your neighborhood. You're not, in general, shopping the way that we used to shop at shopping centers. You're going there because it's a restaurant or it's a nail salon or it's some sort of service. And so I think that really like there should be a shift in the way that we call shopping centers. I mean, I think they're more like service centers, but service centers kind of sounds like a car shop, you know what I mean? But think about that. Why do you go to shopping centers around you, whether it's to go pick up something at Walgreens or to go to the dry cleaners, which is less. So people's habits have shifted, but it hasn't gone away. The things that have gone away are gone probably for good, except some companies that have pivoted. For example, do you have a Best Buy near you by chance?
Yeah, we do. Yeah.
And so, I don't know if you ever go there, but next time you go there, I would, if you had asked me 8-10 years ago, is Best Buy still going to be around? I would have said, no, Amazon's going to wipe them out.
Mm-hmm.
And look at their stock. It's incredibly high right now. So why? Why is it? Why is their stock going up? Why are they still thriving? Well, they're typically in really great locations. B, if you go in there, you'll start seeing that the space within it has basically been outsourced. So like you'll see like the Apple, like it's like a mini Apple store in there, or there's like a row where it has all the Amazon Alexa products, or it has, AT&T. So, and they have all the different TVs, right? And everyone knows you can go into Best Buy, look at the Vizio and the Sony and the Samsung and like whatever your eyes think is best, go buy that on wherever, Costco or Amazon or whatever you want to do. Mm-hmm. And so all the, my understanding is that the Samsung and the Sony and the Vizio, they're basically subleasing space to be able to put their stuff on display and on the wall. Mm-hmm. And therefore it's created, it's just retail has pivoted is basically the point I'm trying to make. And so there's been this massive transition and so even in COVID, obviously we've seen a lot of things change and people are just adapting and moving forward. And, certainly some companies have not survived, movie theaters and, things like that. And then there's, some winners that have come out of this, like who would have thought GameStop of all, tenants, which we have at least 2 in our portfolio. And so there's so many different examples, and I would hate to, advise somebody to paint a brush over all of retail. Like, stop and think about it. Like, look at the like I was talking about earlier, the unit economics mm-hmm. or the fundamentals of the widgets that tenant is selling in their business. Mm-hmm. Does it still make sense? Is the question that I suggest people to kind of dive into and look at whenever it is that they're looking for a commercial real estate investment.
Got it. For folks that, are trying to get into the syndication way of investing in that space, what questions do you recommend they ask the sponsor?
Yeah, track record is certainly a great place to start looking at, first of all, how transparent are they about it? We publish our returns on a quarterly basis so people can see exactly like what we projected those returns to be and what they actually were. In some cases, most cases it's higher, but in certain cases it's lower. Why? And so we can have a one-on-one conversation about that. I think just personalities, do you have chemistry? I think in any kind of relationship, chemistry is important, and you don't know it until you actually get to speak with somebody. Like, do you get along with this person? Do you trust this person? So, things like that. How focused are they? Is this the one thing that they're focused on? And, or is this just kind of like a side gig where they're trying to put together a partnership and buy whatever, syndicate whatever it is that they're trying to do? I think it's important to be really focused. We believe in a book that was written by a guy named Gary Keller from Keller Williams called The One Thing. Have you heard of this book?
I haven't read it.
Yeah, right. And so there's so much power in being able to focus on that one thing. Let's see what else I could think of. I think digging into the tax benefits and understanding that is an important piece of the puzzle. Understanding what kind of returns are available, the time horizon that is anticipated for the whole period.
Mm-hmm.
Are you exposed to a cash call? How much debt is going on the property? Stuff like that.
Any goals like for you or the company? It's like any short-term, long-term goals that you're focusing on?
I'll say it. So we're at 350 million of AUM. We're aiming for $1 billion. So I think that'll probably happen in the next 5 years, if I had to guess. Got to have tres comas. So that's pretty exciting. I really don't see any reason why we won't get there over time. Our mission that we talk about on a daily basis, in every decision that we make, is first and foremost to protect our investors' capital and then grow it. So in other words, return of capital is more important than return on capital. So that's our mission, and that's our number one goal.
Sounds good. Just a few more questions. One question I have is what does success mean for you personally?
Oh man, I love that question. So success, I'll just kind of shoot from the hip. So having more passive income than, monthly expenses, which, frankly, I'm just now getting there, which is pretty awesome. Being able to spend my time however I want, which is kind of tied to that same goal. Being able to be involved and get back in the community, which I'm heavily involved in the Jewish community here in Austin and on the national scale as well. Being able to take care of my family and friends and really just, I'm someone that just loves to have fun, and I'm pretty good at it. I just enjoy having fun, being outdoors, staying healthy, and try to meditate every day, do a little stretching, work out. And I think sleep is underrated. I think people need sleep. Sleep's very important, I guess is what I'm trying to say. Those are things that resonate with me around success, and always just trying to learn. I have a massive thirst for learning. So.
What's your personal superpower that's already attributed to your current success?
Man, my superpower, I didn't know it before until probably the last couple of years, but teaching. I've really enjoyed being able to teach people, and I talked about this earlier, but just sharing the wisdom that I've been lucky and blessed enough to learn from my mentors, and to be able to teach other people is like a true passion of mine. So, yeah.
And how can somebody get a hold of you?
Sure. So the best way to get a hold of me is through my website, hjhinvestments.com, or you can find me on all the socials. I'll spell my name, Ben, B-E-N, last name Kogut, K-O-G-U-T, Kogut. And would love to connect with anybody that's interested in learning more or wants to get on our investor list or anything like that.
Oh, cool. Well, that's all the time that we have for today. Thanks, Ben, for joining me on this episode. I really enjoyed our conversation. Appreciate you and all the value you brought to my audience. So thanks to my listeners for checking out this episode of the School of Cash Flow. And so until next time, live life abundantly.
Thanks for listening to another episode of the School of Cash Flow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.